Greetings and salutations, everybody. It's David Duford here at davidduford.com, where help insurance agents like you become top producing insurance professionals. And in those times where I can't help, bring experts in the respective fields on to take my place and help with common questions for popular programs that are out there. So I'm doing an interview today with Sari Ibrahim, FinAssetProtection.com. Say hello, Sari.
Hey, David. Thanks for having me on.
Yeah, thank you for being here. So why don't you tell us a little bit about yourself and why you agreed to be on my interview?
Yeah, definitely. So a lot of a lot of agents that follow you. My background is in Medicare. I started off as actually before that I worked at Allstate selling mostly personal auto, personal home products. Then transitioned into becoming an independent broker, selling Medicare supplements, Medicare Advantage, prescription drug plans, and that was kind of my specialty for a while. And one of my clients asked me if I could help him with life insurance, and he was more concerned about the cash value part of a life insurance product. And I didn't really know much about. I had my license in life insurance, but I didn't really know much about it. So did some research, went on Amazon, looked for some books. I came across the book, The Bank on Yourself Revolution by Pamela Yellen. And the book pretty much talks about the bank on yourself concept and using the cash value, the living benefits of a whole life insurance policy. And that kind of changed, that took a twist in my career. Now that's what I do full time. That's my specialty. And pretty much that's what this interview is going to be about, right?
Yeah, so the purpose of this is I know a lot of agents are probably in the same situation I am. I've heard of bank on yourself or the concept for a long time, but I've never actually sat down and took time to understand it. So you approached me to do this and I was equally intrigued. So I thought, well, hell, will educate me and everybody else in my audience, because I'm sure many are kind of in the same situation as you really once were too. So why don't you kind of take us from the top and explain in layman's terms, and somebody who's brand new, an agent brand new to this idea, what is the Bank on Yourself program all about?
Yeah, definitely. So pretty much to break it down, there's, in general, three types of life insurance, right? There's term, universal, and whole life. We're talking mostly about whole life insurance. And the bank on yourself concept is just a way to structure a whole life insurance policy. And it's mainly for the cash value, the living benefits of the policy. With that, the bank on yourself concept is also similar to the infinite banking concept, to circle of wealth, family wealth, other concepts out there. Those are just trademarks, it's marketing methods, but the underlying program or the underlying product is usually a dividend paying whole life insurance product. So that's what it is. And it has to be properly structured in order for the client to benefit from the cash value properly. And what I mean by that is, number one, it has to be from a mutual insurance company. So it has to be a whole life insurance product issued from a mutual insurance company, as opposed to a stock-owned company. So the difference is mutual insurance companies give their dividends, their profits back to the policy owners, which are the insureds, and then stock-owned companies give their dividends back to shareholders. If you have a whole life policy issued from a stock-owned company, you're not going to receive dividends towards your cash value. So that's going to affect your objectives, your financial objectives when using the cash value of the policy. So it has to be a mutually owned insurance company. The second layer is the policy has to be structured properly. It has to be, so a lot of whole life insurance agents and the traditional way of whole life insurance is usually 100% base only. It's just straight whole life insurance. And that's what explains the little cash growth when you structure a policy that way. The bank on your software, the infinite banking way, would be capitalizing more on the paid up additions rider, the cash value rider part of the policy, to add in on top of the base. So imagine you were building a house and you told the contractor, I want a 4,000 square foot home. And the contractor just says, all right, 4,000 square feet, but put it all in the foundation. You're going to have a huge basement. That's going to be your entire house, but no really purpose. There's no actual house on top. Same thing with the whole life policy. If you structured all 100% base, yeah, you're going to have a death benefit and only a death benefit, and the cash value is going to be really tiny. But if you do it the bank on yourself way, and it depends on the company, it depends on the age, it depends on the person's needs. But let's say for the sake of the example, 50-50. So 50% goes towards the base, and the other 50% goes towards the cash rider, the paid up additions rider. Now we can turbocharge the cash, and the client can actually see the value of the policy grow significantly as opposed to the traditional way. So number one, it has to be a mutually owned insurance company. Number two, it has to be properly structured. Base and paid up additions have to be a kind of a healthy balance between the two. And the third part, David, is the policy must have non-direct recognition loan feature. And to explain that in an easier way, let's say you have a whole life policy, right? It's structured the bank on yourself way, and you have about $100,000 in cash value in this policy. Now, let's say you come across an opportunity, you want to invest in leads, you want to buy more telemarketers, you want to grow your business, you want to scale up, and you're projecting you need about $50,000 to do so. You can go to your policy and use that money. Now, when you go to that policy, you're going to borrow from the insurance company. You're not going to subtract $50,000 from the $100,000 cash value. You're going to borrow $50,000 from the insurance company, leveraging your $100,000 cash value. And then while you're using that $50,000, if it's a non-direct recognition company, the insurance company is going to keep paying you dividends and interest on your $100,000 cash value as if you've never touched that money. Now, if it's a direct recognition company, the insurance company is going to recognize that loan, and they might deduct interest and dividends from you because of the outstanding loan you have, deterring you from using their money, from using the policy loans.
Right.
So you want to make sure it's non-direct recognition. And I know that's a lot so far to just throw out there.
So, here's my first thought, Sari, when I'm hearing about this product. So probably you hear this all the time, but I'm thinking kind of like a prospect, like, okay, sounds good. But what you're describing, couldn't I just, put my money in a 401k, SEP IRA, some kind of retirement vehicle? Why would a prospect want to do what you're describing here versus just the traditional, what everybody tells you is the better way, right? The traditional retirement strategy. Why your way versus the other?
Exactly. Yeah. Let's dive into the 401k example, for example. So let's say that there are some issues with the 401k. Number one, the fees. The fees tend to be 1% to 2% every year, and that 1% to 2% kind of compounds over time, and it kind of eats into your balance. That's one problem. The second problem with 401ks is the contribution limits. As of this year, it's $19,000 per year. So let's say that you want to allocate more than that. Let's just say that the prospect wants to allocate more money than that. A 401k in this situation wouldn't really be feasible. It wouldn't really make sense for that client. Number three, which is probably the biggest disadvantage of a 401k, is liquidity. You have to wait until you're 59 and a half to access that money, or if you access it before 59 and a half, there's a tax penalty plus ordinary income. You have to pay ordinary income on the withdrawals. So definitely liquidity is a huge issue. Number four, market risk. So right now, there's a lot of risk in the market. Obviously, post-COVID, or we're still kind of in the COVID timeframe. There's a lot of risk, and who knows what's going to happen by the end of this year. There's a lot of, you can't really predict what's going to happen in a 401k. A lot of market risk. So you have to be kind of open to that market risk and willing to accept it when investing in a 401k. Number five, integration. So let's say that you're in a situation like, should I put $10,000 in a 401k, or should I invest it in my business, or should I, buy leads, or whatever the case might be? You have to choose one of those routes. But with the dividend paying whole life route, I can fund the policy, add in the premiums, and then borrow from the insurance company. My cash value continues to grow as if I never touched it, and use it for whatever I want, for my business, for lead generation, for anything else. But with the 401k, I can't do that. I can't put into my 401k and then borrow out and keep it in there at the same time while still growing. I have to choose either or. So the definitely integrated part is definitely a major component. And of course, the last part, the sixth reason, is taxes. With the 401k, you are using pre-tax dollars, deferring taxes, putting it into the plan. And then when you go to take that money out in your later years, you're going to be taxed at that rate. Now, there's a lot of arguments out there regarding tax rates, and I definitely think almost certain that tax rates will be much higher in the future based on the Medicare budget, Social Security budget, and the rise of national debt. The government's going to need a way to increase taxes, and 401ks and other qualified plans are the low-hanging fruit for the government. If they know that there's trillions of dollars in those plans, it's easy to increase tax rates, so that way the government can reimburse, Social Security, Medicare, and debt interest on national debt.
Right, you're going to pay the tax now or pay it later is what it's really going to come down to. And there is an argument to pay it now, with after-tax money now versus later, because who knows what's coming, but it's coming.
Yeah.
So And I think you're kind of hitting on this as we go through this, but let's just be clear again for everybody who's watching. This is brand new. What is really the benefit to the agent to sell this kind of product versus some other kind of product?
Yeah, definitely. So as mentioned, I've sold, personal auto, personal home, Medicare supplements, Medicare Advantage, prescription drug plans, term life. Out of all these products, the client is kind of positioned, even with value, even with the best companies, there's kind of like a fence between the client needing that product and then them willing to spend money on it. And they kind of see it as a commodity. It's kind of a commodified process where you as the agent have to position, the best product for the best price, except for dividend paying whole life insurance. This changes the table. This goes from, instead of the client buying insurance, to the client thinking, instead of keeping my money in the bank, I can shift it over and put it into this whole life policy. And that eliminates the cost basis or the cost argument of things. It's, instead of me buying insurance, I'm moving money from point A to point B. I'm moving money from my bank to this whole life insurance product because I see more value in my money sitting here than my money sitting in the bank. And what this means is, this means that you have kind of an endless opportunity to how much a client is willing to move money over to your account, to your whole life product. It's much, once clients understand this material and they understand, there's a lot of content out there that you can provide them and they can kind of learn, teach themselves and train themselves. And once they do get to that point, the opportunities are endless. So again, opportunities are endless. Also, you tend to get a lot more referrals when you're able to help people better position their financial health. Now there's some downsides, and let's just put the downsides out there. A lot of insurance agents and financial advisors know about this concept, but they hate it. And the reason why they hate it is, do you remember in the beginning when we talked about the all base and then splitting it, paid up additions? If a lot of insurance companies pay really, really high commissions on base only whole life. They can pay, sometimes I've seen like 80, 90% commission of the first year. And sometimes agents that sell a lot can earn upwards 100% or even more over time with bonuses. But when you slice that base in half and do all the paid up additions rider, you're cutting your commissions in half too. So a lot of agents are going to say, well, I hate this product because I don't want to split my commissions in half. But here's the flip side to it though. When you do that, when you position the policy to benefit the consumer more than yourself, that should be the case always. The consumer, the client should benefit more from the policy than you. But let's say that you're able to structure it that way and the client can walk away the winner. What's going to happen is, number one, you're going to have a much higher closing ratio. Number two, the clients are going to put more money into the policy. They're not buying insurance, they're moving money into a whole life company. And number three, you're going to get a lot more referrals from that. So kind of, I would, if I'm giving advice for agents, don't necessarily look at 80% versus 40% commission or 35% versus 80% commission. Look at the long run and the overall picture of structuring policies this way.
Yeah, well, you made some interesting points to think about. We're all, especially in my field, mostly in final expense, and to an extent, Medicare, where it used to be, there is a commodity-like psychology, right? It's the race to the bottom, who's the cheapest to provide the most coverage. I mean, you can operate a business like that, but it doesn't give you any real points of value or differentiation. I mean, it does, but not to the extent like it does here, where you've totally changed the psychology of why one would want to buy. You've changed this conversation from, death benefit to something greater. And it changes, again, what the person will do in order to make this happen. And it's great. It's a great strategy. I can definitely see how one can get a lot more premium. And I just say it will agree with you too. I mean, I always instruct my agents, just do the right thing for your client. The money's always going to follow. I'm sure it's the same with you. I'm sure you get more referrals. You sell bigger policies. It'll take care of itself. Don't go after every percentage point of commission. Mm-hmm. So imagine this. I'm driving down the road. I've just got done listening to hour 3 of the Dave Ramsey show. And Dave Ramsey's yelled and screamed at me about how stupid whole life is. And you're a dummy if you buy whole life insurance. You should buy term and invest the difference. Yeah. And I know you hear this because there are some termite believers in the buy term and invest the difference. How do you deal with that objection? Because a lot of people are exposed to Ramsey's work, and he's got some good stuff for sure, but how do you position this to deal with that?
Yeah, you're right. He does have some good stuff. I'm not going to completely bash him. He does have some good stuff. But when he talks about whole life insurance, he's talking about that 100% whole life insurance only. And in that situation, I would never recommend it to anybody to just do only whole life insurance and wait years just to see a little cash value growth. I don't think Dave Ramsey knows about the infinite banking slash bank on yourself concept. And I think that for some reason, he is really inclined to pushing people towards the stock market, buy term, invest the rest. Well, I think the most important thing is that, and if a lot of your prospects and clients are business owners and investment minded people are really focused on predictability. And that's something David Ramsey can't talk about. He can't talk about predictability. To buy term and invest the rest is not predictable. Yeah, sometimes the market is going to do good. Sometimes you might come out as a winner, but you can't predict that. You can't necessarily control it. So that's the argument I would make against Dave Ramsey when it comes to whole life insurance, is that you want to be able to, and as the agent yourself, as a business owner, you want to be able to predict things. You want to be able to say, in 20 or 30 years, how much money will I have for retirement? How much will my death benefit be? How much will my family get if something happens to me? You want to kind of break down these numbers. And again, I don't think that Dave Ramsey can do that when talking about whole life insurance.
So let's talk about that. That's what I'm really interested in. So yesterday a couple of days ago, I was at jiu-jitsu, and this kid that is in class with me, he's getting into real estate. He's doing fairly well for himself in his mid-20s, and his dad's had his best year in real estate. So I meant, you sent me those questions over, and you wanted to talk about why, business owners and real estate investors would want to use this. And I'm curious because I think like a business owner, Sarah, I think, okay, if I'm a real estate guy and I know my objective is to expand, is to buy and to hold or to flip, I want my money utilized in a way to scale that business. What's the sales pitch to a real estate guy or a business owner, why they would want to divert some of that capital into whole life plan when maybe their initial thought is I just put more money into real estate? How do you deal with that?
Yeah, definitely. So with all my clients, what I do is I kind of have like the intro call. And a lot of it's done over the phone. So I have the intro call that kind of just talks about the bank on yourself concept, the infinite banking concept, just to see that we're on the same page and where we're going. And the second call I would have is a full 90-minute assessment, a financial analysis / assessment. And during that meeting, I'm not giving any insurance advice or any business advice at all. I'm simply listening. I'm asking questions only. But I'm doing about 30% talking. They're doing 70% of the talking. And I'm just learning from the clients. And during that assessment is that when they'll usually kind of confess or talk about, what they do in their business. That's when they kind of reveal, like, a real estate investor I was talking to the other day was saying he's mad that he has like $200,000 in cash and only earning him 1% interest. He needs that money to move. Other real estate investors, a lot of real estate investors actually think that way, where they don't want their money to sit in one place and earn very little interest. There's a loss of opportunity cost. So I'll kind of gauge their mindset and see where they're at and see what their opinion is on money sitting somewhere. And then from there, be able to build a solution that connects both of them. Because think about it this way, as a business owner, of course, you don't want money to sit there and not make you any money at all. That's loss of opportunity cost. But also when your money is out of your hands, there's also a liquidity problem too. Because what if all your money is invested somewhere and now you need that money back? In 2008, before 2008, a lot of real estate investors, that's exactly what they did. They would just buy properties, and any cash they would have, they would roll it into new properties, and they just have lines of credits and mortgages rolling. And they just relied on banks. And their opinion was, I'd rather have all my money sitting in real estate properties, pay low interest on all these loans than to have cash sitting in my bank account. But the problem is after 2008, when banks also lost a lot of money, banks started calling their loans, meaning that they wanted their money back. They stopped giving out lines of credit. Now real estate investors had all these properties with equity tied inside the drywalls. They couldn't be able, there was no liquidity. So using a dividend-paying whole life insurance product for real estate investing addresses those two concerns. It addresses the opportunity cost where your money is always earning interest, and it's liquid too, because you could fund your policy, borrow from your policy, buy real estate, and then pay yourself back the policy loan, and always have access to that money. When you fund your policy and you want to go access that money, there's no underwriting involved. The insurance company is not going to say, well, how much money did you make last year? Can you send us tax returns?
Right.
There's no underwriting involved at all. You always have that money available, even if you're in the middle of a bankruptcy, even if you have terrible credit, there's liquidity always with that policy. So I think that's what makes, I think, real estate investors jump on it. But again, it all comes down to the assessment. Out of all the products I've sold in the past, this product is the least pushiest product. Everything else, I can go to somebody with just a couple questions. I can get a lead from somebody, find out 2 or 3 details about them, and then move right in for the product and get the close. But with this, I've never sold a product that way. I've never sold it this way. I have to go through the full assessment. It's like a negotiation. I have to position it for the client to say, I want this, and this is how much money I want to put into it.
Yeah, it's pretty cool, man. Now, you didn't have this question here, so you go into as much or as little detail as you want to. So we've got an idea of how this product works. I mean, it's so funny. This business of insurance sales there's so much opportunity. It's just like you cannot not find opportunity. I'm kind of excited, literally excited to listen to this. It's like, man, I could do all sorts of crazy things with this. But how do you find people to talk to about this? Like, how are you targeting? And again, if it's confidential, that's fine. But what would you kind of say to an agent that would ask that question? Where do you go to find prospects for this?
Definitely. So with this product, it requires a lot of content. So either content that you create or that you can leverage. You can, so I'm part of the Bank on Yourself organization, which is kind of like an IMO/marketing organization. And the author, Pamela Yellen, she writes books, she's on podcasts, and I get leads through her book. So somebody, for example, like just how I did when I bought the Amazon book, at the end of the book, it says, if you'd like to speak to an advisor, call this number or fill out this form. So I get leads from that. That's one source. And also I'm on podcasts. I'm on other YouTube channels. And I have my Medicare book of business that I cross-sell this to. So I think if you're an agent, you're interested in selling this, you definitely need content, a lot of content, because your ideal customer is going to be somebody that's going to be educated. They're pretty much going to be like, above the $100,000 a year income mark. They're going to tend to live in more affluent areas. Now, it doesn't mean that should only be your target market, because you will have people that almost live paycheck to paycheck, and their mindsets will shift and they'll start using these products. So you don't want to ignore everybody and only specialize on a certain people, but just know that the vast majority of people that use these products tend to be educated. They tend to read a lot. They tend to listen to a lot of podcasts. They watch a lot of YouTube. They use social media primarily for business and educational purposes. And you want to be in that realm of education and connections.
All right. So it seems like got to find an open-minded person who's willing to listen, and then provide them content. It sounds like what you're doing this is exactly your prospecting process, which is smart. It's just to capture people with open minds and give them the content to kind of fill the gap, because there's a lot to learn here for sure. So, well, cool, man. Sarah, this is great. I really enjoyed this. Can you remind my audience what they can do if they're interested in working with you, whether as a client or otherwise, how they can find out more about you?
Yeah, definitely. You can go to Fin, F-I-N, assetprotection.com, finassetprotection.com. And in there's an appointment booking calendar. You can book an appointment, or you can email me. You can call me, whatever you'd like. Yeah,
and if you're watching this and you didn't hear that or can't find the rewind button, look below in the video and the description box of the YouTube video, and it'll be there too. I'll make sure to put that up there. Sarah, thank you for your time.
David, thanks for having me on.
Appreciate it, man. We'll see you.